choosing your battles. Pick yourself up and dust yourself off and back in the saddle. You're on the front line, everyone's watching. You know it's serious, we're getting closer, this isn't over. The pressure's on, you feel it, but you got it all, believe it. When you fall, get up, oh, oh, and if you fall, get up, eh, Samina, mina, sangalewa, cause this is Africa. Samina, mina, waka, waka, Samina, mina, sangalewa, this time for Africa. Listen to your God, this is our motto. Your time to shine, don't wait in line, y vamos por todo. People are raising their expectations. Go on and feed them, this is your moment, no hesitation. Today's your day, I feel it. You pave the way, believe it. If you get down, get up, oh, oh. When you get down, get up, eh, Tamina, mina, sangalewa. This time for Africa. Samina, mina, waka, waka, Samina, mina, sangalewa. Anawa, Samina, mina, waka, waka, Samina, mina, sangalewa. This time for Africa.
I'm well on my journey, biggie, biggie mama, one A to Z. My sister's all on my journey, biggie, biggie mama, from east to west. My tea, waka, waka, my waka, waka, my Sangin' sis, sama zingu, yeah. Cause this is Africa.
Samina, mina, Anawa, Samina, mina, Samina, mina, Anawa,
Samina, mina, waka, waka, Samina, mina, sangalewa. Anawa, Samina, mina, waka, waka, Samina, mina, sangalewa. This time for Africa. Tango, tango, Samina, mina, sangalewa. Anawa,
Switching on a light shouldn't be this complex. Neither should choosing where to invest your money. With Cinnabar Investment Management, we take the complexity out of investing, ensuring the right fund for the right investor every time. Cinnabar Investment Management. Complexity simplified.
Good morning, everyone. Welcome to Cinnabar's Q1 quarterly feedback session. Thanks so much for joining us this morning. It's a bright, beautiful morning in Johannesburg. We've got a very exciting lineup today, and I'm going to crack right into what the agenda looks like. So we're first going to go into a business update, and we'll take you through what's been happening within the Cinnabar ecosystem. We'll then move on to a market review and investment insight piece given by Carl Isernhinke, and I'll introduce Carl in just a moment. We'll then move on to Geoff Blount's section, where Geoff will be talking about the Cinnabar philosophy, taking us through, very importantly, what the performance has been looking like over the past quarter, the past year, and how the portfolios have been positioned and what the future positioning looks like. After that, we've got a very exciting guest speaker, Emilise Rautenbach, He's going to be talking about the behavioral barriers to financial success, and very much in line with our purpose to create and protect intergenerational wealth. Emilise is going to help us understand what's stopping us from achieving financial success. We'll then wrap up and have some closing statements and leave plenty of time for a Q&A session. So as always, before we begin, I'm going to go straight into what our purpose is. And just as a reminder, our purpose is to create and protect intergenerational wealth. We use our values as our guiding light, where we have invest our effort for value. We don't like wasting energy. Our second one is coming up. I think bring them all right up, Cam. Challenge, but don't be disagreeable. So we encourage challenge within the team. And we've strengthened our IC, which I'll get to in a moment, quite significantly. And by strengthening our IC and bringing more people into our investment committee, more very bright people into our investment committee, the amount of robust debate has actually increased. But it's been very, very healthy for the team, and more importantly for the portfolios. We strive for simplicity, keep everything as simple as we can. We've got an absolute hunger for growth. So we look for growth within the portfolios, growth within ourselves, and growth within our country. And most importantly, we are not owned by any large company. So we're not owned by any large life insurance company, which means that we can approach our investments completely independently. And with that said, I'm going to go into the next section, which is Cinnabar ecosystem, and just remind us about what the ecosystem looks like. It's an exceptionally powerful ecosystem. And we're starting to think about this ecosystem more as a network than simply an ecosystem. It's a network that independent financial advisors can belong to without changing their FSP, without giving up their independence. And have all the bells and whistles that come along with a network that usually forces you to go into a set structure. So at the heart of the offer to independent advisors is that we look to help them double their profitability and scale their service delivery to clients. So double profitability and scale service delivery. We also offer WealthBit, which is cutting-edge technology, financial planning technology that helps scale advice to clients, and very importantly, gets the clients involved in their own financial plan and gives the clients a login portal to their own financial plan, so that the clients are really engaged. What WealthBit does, in addition to the software, is it helps create an enriched data set. That enriched data set we then use in something we've called a book risk analyzer. And the book risk analyzer analyzes every single client's portfolio each month and determines whether that client's portfolio is in risk or out of risk. Very importantly, if it's out of risk, it could be too risky, in which case the client could get a bad experience on the downside, or it may not be risky enough, in which case the client won't get a good enough return at the end of the day and is unlikely to achieve their financial objectives. So we also offer implementation and support to independent advisors, where we leverage our entire team with a lot of technology to help streamline operations and boost the client experience. And then lastly, and very importantly, we have various succession options that help secure the future for all clients, and also the future for the independent financial planners themselves. So that is the ecosystem, and it's really getting stronger and stronger every single quarter. And this quarter, what we've done, and the most important one, I've asked that it was put first, is that we strengthened our investment committee significantly. We added 2 seasoned professionals to the investment committee. The first person is Carl Isernhinke on the left, and the second person is Becky Mafulela on the right. They're exceptionally well known in the financial services space in South Africa. Carl has he studied actuarial science. at Wits. He's been working in the investment space for a number of years. He worked for PSG. He worked for Abvest, and then ABSA in the structured products division. He was a chief investment officer at Clade Investment Management. He then moved to Sasfin, where he was a portfolio manager, and he was also a chief investment officer. And then more recently, he worked at Luna Capital. And a little quirk about Carl is that he had a midlife crisis at age 40, and he went from being Carl, have you don't mind me saying, a little bit tubby, to being a very, very well-defined and muscular individual, and he now does trapeze. So where he's a co-founder of a company called Cirque, and they've got an operation at Cresta, and they do trapeze acts. So Carl, good to have you on the IC, and thanks for your contribution already. And then Becky joins us. Becky studied at the University of the Free State, where he got his postgraduate degree in financial planning. He also studied in Cape Town, UCT, where he achieved his ACC and his CID. And also importantly, he completed his CFA qualification, Chartered Financial Analyst qualification. He's worked at a number of very well-known companies. So he started his business career in Zimbabwe, and then moved to South Africa and worked for Old Mutual for a couple of years. After Old Mutual, he moved to Allan Gray, where he worked at Allan Gray for over 6 years and picked up an enormous amount of experience. Then he moved on to Momentum. And within Momentum, he was the head of retailization and strategic markets. And more recently, he started his own venture, and hence the reason that we're lucky enough to pick him up as an investment committee member, where he's already added immense value. So strengthening the investment committee is probably the biggest win for this quarter, but we've had a few other very big wins. And the first one is that we've come to an agreement to amalgamate another balanced fund into our Balanced Plus fund. So it'll make the fund roughly 300 to 400 million rand bigger. And with that size comes more scale, and with more scale, we have more bargaining power with fund managers that we employ. The next very big win is that we have made progress on the Global Equity Fund launch. So we've been talking about this for a while, and it was a missing chink to our armor, where we had an overseas balanced portfolio, which is doing well. We didn't have an overseas equity portfolio for aggressive investors overseas, for those looking to target CPI plus 4 or 5 overseas. So personally, I've been investing in the Cinnabar Global Balanced Fund because we didn't have a global equity fund. When the global equity fund launches, I'll be moving the majority of my personal holdings and my family's holdings to the global equity fund, because it's more in line with my risk profile. And then a bit of an accolade is that Allan Gray had made the decision to add our global balanced portfolio, the Cinnabar Global Balanced portfolio, onto their platform and make it available. And Allan Gray doesn't add portfolios to their platform all that readily. It happens few and far between, but they've decided to add us to their platform, which is great news for all of us. We now have access to the investment portfolio overseas on Allan Gray. So that's a business update. I'm going to hand straight over to Carl, who's going to be taking us through our market update. So Carl, without further ado, over to you.
Hi, thank you. Thanks so much for the introduction. Yeah, let me share my screen. Okay, and share. Okay, great. Well, thank you, Alex. Yeah, well, very excited to be part of Cinnabar going forward. So Alex asked me to just chat about and give you a market update and some of the insights into what I see going on in the market at the moment. So just as a quick summary of essentially what happened over the different asset classes over the first quarter of the year, you see global equities was the top performer. And that's been the theme actually, if you look at it for the last 5 years. Pretty much mostly been a global equity market, mostly driven by the US market. And even if you look at how well the dollar's performed as the second best performing asset class, it's not just rand weakness. It has actually been the US market outperforming every market, substantially more than South Africa over the last quarter and year, but even over 3 and 5 years. 5 years you did twice as well in offshore equities as you've done in local equities. And also significant, the bonds had a better year last year. 2 years ago, they really had their worst year ever, the global bonds. So there was a bit of a recovery last year, but it's still, if you look at the 3-year time period, global bonds have still significantly underperformed everything else. And that's also gone over the full 5-year basis. And once again, South Africa equities, as we've known, have been dismal performers for the last year and actually for the last 2 years, pretty much. And well, that's pretty much what the market has done. For me, it's always more about what are things going forward. So I'm going to chat today a little bit about some of the things that I think are most relevant at the moment. And probably what's biggest on our minds is what I say is the changing political order. I mean, we all see it every day now. You've got, the Russia-Ukraine war. You've got the Middle East conflict. You've got the world basically moving from a unipolar system where it was, dominated by the West, the US and the West, to very much a multipolar system. And that comes with a whole lot of consequences. You're seeing it in, I almost want to call it proxy wars, if you want to think about it, whether it's Ukraine, Middle East, and other conflicts all over between, the West and the East. That as the world goes, but it's also within countries. You're seeing it in politics, the massive division you have between left and right all over the world. We've got all the other events as well. Climate change, that's also creating all those problems. And we always look at what are the effects of this? Is it a positive? How is it going to affect never mind our lives, but our portfolios and that going forward? And when we look at conflict, there's quite a few things we can actually say what happens. I mean, you can see here that we're entering almost a new era, an era of greater conflict that we haven't had for a long time. We had, pretty much, we've almost had like 3 or 4 decades of relative peace, and now we're seeing, it's almost in terms of the cycle, we're starting to see increased geopolitical risk. When geopolitics was pretty much a whole boring section for most of the 90s and 2000s, and now suddenly it's all coming alive again. And what are the effects of these things? Essentially, if you look here from the IMF, they looked at different consequences of the different types of geopolitics. As we've seen now, we're starting to see almost a deglobalization section. And what happens with that is the main thing is it is inflationary. Why? Things cost a lot more because the US isn't defending the ocean so much. You have higher risk of, cost of shipping. You get, you're going to get the Red Sea's closing down, insurance rates going up on ships. So basically getting the cost of anything everywhere ends up becoming a lot more expensive. You have, now you have to reshoring as everybody's now trying to, take control of their own manufacturing base, especially on important geopolitical or important strategic things like semiconductors, things like that. All of that's requiring a massive build out. At the moment, the US is having its biggest build out since World War II internally. That's also inflationary, but also while it has initially a lot of positive GDP impacts because of the initial spending, like with all inflationary things, as you know for yourself, if the petrol price starts going up and you have less to spend on other things, it ends up actually reducing what you can spend on other things. So the net effect generally of deglobalization, if you want to look at that, is generally higher inflation and lower GDP growth. But we go through these massive cycles on a, I wouldn't say on a very regular basis, but if you look at that, history gives us lots of lessons of what, where the pitfalls are and what we can actually do. I mean, it's just because the world's going into a higher conflict zone. By conflict, I mean, there are the kinetic wars like you see in Ukraine and the Middle East. As one commentator said it, for a lot of this conflict, firstly, it's been a hot war in cold spaces. That was from Pippa Malmgren, where initially it was a lot of things, people shooting down satellites or shooting their own satellites down, but creating a debris field that would make it possible to use satellites in those places, cutting a lot of the cables. I mean, it's far bad in, that's an island just in the North Sea, which has the biggest internet cable in the world, because that's the download point for most of the satellites. You saw that was cut. Well, it's actually been cut a couple of times, but it's not like a small cut. I mean, it's cut in about a kilometer of fiber optic cables removed. So you've been seeing a lot of those things, which the press doesn't really talk about because it's not as exciting as showing bombing and, tanks. But that's been going on for a while. Now it's progressed to almost a Cold War in hot places. If you want to think, a lot of commentators call it Cold War II happening now, pretty much between Russia and China versus the West. And that's now, you're seeing it in hot places. You're seeing a lot of what's happening in sub-Saharan Africa, where you see, Russia's got the Africa Corps has really moved in and taken over a whole lot of areas there. You're seeing it in Ukraine. You're seeing it in the Middle East. So once again, the world's starting to divide up. Cold War II is something that as I said, a lot of commentators have talked about in that. But as I said, once again, these things, while they are concerning, they're also, it's a cycle that has happened before. And we can see, certain lessons from history about how we can actually handle some of these things now. And that's what I'd also like to talk to you a little bit about today. So some of the things that we can look at. So firstly, I think the big thing that's been, that everybody's got on the mind is the US debt. I mean, that has grown now to a significant 34.5 trillion. And because of the big deficits that the US government's running, that's increasing by about 1 trillion pretty much every 100 days. So call that about, just over 3.5 trillion a year of new debt. As you can see, the last time it was that high was back just after World War II. So that was the US just coming out of World War II. And then they increased it. They spent a lot more with the Marshall Plan, because after Germany was defeated, they ended up spending a vast amount of money actually rebuilding Europe to turn Europe into an ally for them. After that, you can see that the debt continued to fall all the way till the middle 70s, where it was about 30% of GDP, to the early 70s. And then the US got off the gold standard, and we moved into a full fiat system. Fiat means, free floating currencies, and, debt's managed to increase, and we've just reached back to those levels. But just to give you an idea of what's been happening recently and how things start going on an exponential level, like when we were talking about the Marshall Plan in 1944, that was about 5.4% of the US GDP was used in the Marshall Plan. But just to put it in perspective, if you look at the current, the current spending programs that they've had, from the CARES Act, all of this COVID Act, you can see all of those things are coming to a huge amount. That's like 19% of GDP. I mean, that's something like about 5.5 trillion that they've already added. I mean, that puts that also gives you a lot of perspective of, just how much money the US is constantly spending. So essentially what's happening is we've got this situation now where the US debt has increased a lot and is increasing at a massive rate. And, you're looking at whichever party is going to win the election there, whether it's Republicans, the Democrats, or pretty much even if you're going to end up with RFK as that's Robert F. Kennedy, as an independent. Regardless of that, the US is in a situation where it's almost in what you could call that debt spiral, where they have to keep their fiscal deficits so high because the interest rates are starting to get so high here. I mean, if you look here at the actual costs of the US interest payments, that's up to now over $1 trillion a year. And the entitlements, that's their Social Security, their Medicare, their Medicaid, all of the payments that they've promised, the citizens, that's up to 4.3 trillion. So we're looking at already 5.3 trillion already just in constant payments. Now, as interest rates have gone up, that's obviously increased what they have to pay now in interest. And here's where it comes now, or gets interesting, is you can see that they have to, in the next year, they've got to not only add that extra 3.6 trillion of new debt every year that they've got to issue and start pay interest rates in. As their old debt rolls over, that means the way government issues debt is they issue bills which are short term. They like 1 year or 1 year and less instruments where you basically buy it and then you get the money back within a year, or what they call treasury bonds, which are longer term. That's like 2, 3, all the way to 30 years. So they pay a set coupon every month, and then you get your money back at the end of the term. So you can see there's the profile of the debt that they've issued out there. And you can see within a year, they've got to do 8.5 trillion, and it's about 15.5 trillion within the next 2 years. Now, the problem is those debt was all issued out. It was issued when interest rates were a lot lower. So the current average interest rate coupon was 2.3%. So now, given where interest rates are currently at 5.3, they'll have to pay an extra 3% on that debt. So that's pretty much an extra $475 billion a year of interest. And if you add in that they're going in at the 5.3 rate, that's already another more than 700 billion of interest on the new debt that they're going to issue. So you can see quickly how they're spiraling out into higher and higher interest payments. And that is a situation that's, it's not just the US that's happening, it's pretty much happening everywhere else. We start reaching the stage where this debt is starting to become unsustainable. But they have been keeping it by keeping interest rates up. So that's been keeping this, almost the lid on inflation, because when you start issuing a lot of debt, it's generally quite inflationary. But because I'd say almost luckily for the US, the Federal Reserve is fairly independent of the Treasury. The Treasury is the government department that issues the debt. If we have a look at the Fed balance sheet, you can see that their balance sheet expanded massively to, because of all of that debt, that 5.5 trillion debt that was taken on for COVID, plus all the QEs, quantitative easings that they did over the time. And they've been tapering it down. They've been dropping it by about 1.6 trillion, since 2022. But what's actually been happening is they've actually been tapering that out, which means in terms of the Fed, they've actually been easing financial conditions pretty much since the end of December there. But the big announcement actually last week was that they're going to even halve their taper from, it was about 75 billion a month. Actually, the target was 95, but they never managed 95. They only ever did 75. But they're going to cut that in half to about 40 billion a month. So the Federal Reserve is even being less restrictive. So once again, we've all been seeing, the US economy being strong, inflation being a lot higher. So it looks like that's going to continue even further now, because essentially what's happened is here you can see the taper of the Fed's balance sheet as it's dropped from, 8.4 trillion is essentially the size of it. So it's dropped substantially to about 6.8. But normally what would happen is, like with QE, that QE normally would increase bank holdings, because essentially you're essentially buying bonds away from the banks, you're giving them more cash. And QT, which is quantitative tapering, should be removing liquidity or cash out of the banking system. But what's interesting is, as you can see there, while the Fed bond holdings have been falling, they have not been reducing the bank holdings. And as a result, the banks haven't been forced to go buy more bonds. Because remember, if you're tapering, you're actually giving cash back to the banking system, and the banking system then needs to invest that cash, and normally they then go buy bonds, which would, or they would, because they are needing to take the cash and buy bonds, it would end up or sell bonds, sorry, that have to actually sell bonds because they're now taking their cash out of the repo system or the reverse repo system. Okay, wait, let me start that again because this always gets complicated. So let me just skip to the next one here. So you have the reverse repo system, which is a place where banks used to deposit their or would park cash in, and then they'd be able to then go buy bonds, and that's being drained. So by pushing that down, because money market funds used to go put a lot of the cash into the repo system, but they've been going out and buying all of the bonds that have been issued, which is why it's not been happening to banks. So that stopped the liquidity from being drained from the system. Now that the reverse repo is coming close, it's been dropped down from about 2.5 trillion to only 330 billion. Now that we're running that reverse repo down, we're reaching the end of what we can do for quantitative tightening. That means anything further is going to start, if they had to carry on quantitative tightening, that start draining the liquidity from the banks, and that would start causing financial conditions to tighten. So I think we've pretty much seen the end of tapering, and if anything, we're more likely to see quantitative easing going forward, especially in a year with an election year, as you know, nobody wants to be seeing, wants to create a recession just before an election. But anyway, so the side effect of all of what the US is doing in terms of having these easing financial conditions is you can see here in the gold price. The gold has just recently broken past its all-time high, it was about just under, just over $2,400. It's dropped back a little bit now, but on a technical basis, it's finally broken through these long-term ones. So it's a very positive investment for everybody who's been holding it for the last few months. But also going back to that, the question is, why now? Why is gold suddenly going up now? Because, as a history of gold, and you can look back here for the last couple of decades, is gold has always acted as a currency. Basically, if your real return was high, then you'd want to hold basically bonds or dollar cash and get that high real return. And if you had a negative real return, you'd want to hold gold, because gold costs money to hold. You actually have to have it in a vault. You got to pay to have it. You don't get interest, you pay interest on gold. So the side effect of that is suddenly you can see something's changed here, where the gold real interest rate correlation has suddenly broken apart. And we can see something change dramatically here. So here's real interest rates have gone up. Normally gold would go down, but that changed. And that changed in about 2022. And we always look what happened in 2022. And then there was a significant shift in the system. And that was when Russia invaded Ukraine, the US went and they took about 300 billion of Russian assets and froze it. And actually just last week, they then took that money and they gave it back to Ukraine. So that sent a clear message out to central banks around the world is, if you hold dollars and we don't like you, we can take those dollars if you want. Now, that has made everybody wake up, from Saudi Arabia to, they know that if you irritate the US, whatever dollars you hold can not only just disappear, but can end up going to your primary adversary, as in the case with Russia giving to Ukraine. Now, not saying that wasn't the right thing to do, but the consequences of that means that every central bank now knows your treasuries are not risk-free. So what they've ended up doing is moving dramatically into gold. And you can see that here, the gold price has been going up. The blue line here is the holdings of the GLD ETF. That's a gold ETF in the US, and that's been falling. So the people who hold that, or those that hold the gold ETF, are generally pension funds, retail investors. So they've actually not been buying gold. They've been selling gold. But the gold price has been going up significantly. And why is that? You can see that in a couple of years ago, they opened up the Shanghai, the China opened up a gold exchange in Shanghai for physical gold. And that Shanghai exchange has actually been trading at a premium to gold. You can see now you're almost paying, just over $100 a premium to actually buy physical gold on that exchange. So you've had this a whole difference where essentially gold has been flowing out of the West through to the Shanghai Stock Exchange. So if you actually look at the physical flows of gold, that's all been moving through to, from the West, from the vaults in the West through to Asia and being bought physically in the Shanghai exchange there. And that's going in the terms of tens if not, and hundreds of billions of dollars worth of gold has been moving that way. I always love this cartoon because it really does show pretty much what's been happening. Because up till now, gold, well, for most of our investment careers, or when we've been looking, gold has been determined on the futures and options exchanges in New York and London, where it's been the big banks, the JP Morgan, the Barclays, that have all determined it by derivatives, via the derivatives market, which has been much bigger than the actual physical gold market. But now that the primary gold market has moved, away from the West into, Shanghai and also Singapore, and it's almost all entirely physical. You're actually getting what I'd say almost real price discovery. Now starting to see what the true value of gold is getting closer and closer to actually becoming. And that's actually moves control of the gold price away from the West and more towards, Asia. Well, I wouldn't say control because it's, it's buyers and sellers. So it's I'd say the ability to manipulate the gold price for political reasons has fallen away dramatically. But so gold is one of the ways, and you've seen it in history as I talked about cycles, that have been great to defend themselves for crisis moments. But it doesn't necessarily mean the dollar is going to fall down. Because as you can see, for the last 25 years, whenever there's been a major crisis, the dollar has increased in value. Now, as I've gone through, you have the problem, with this massive debt in the US. You've got the fiscal problem in terms of fiscal dominance, where the US government is spending a whole lot more money, starting to actually crowd out a lot of the private sector, which generally would be considered weak for currencies. But the dollar has something unique. Being the world's reserve currency and also main trading currency, it actually benefits from both systems. So yes, it benefits when it's a strong economy and everything's going well and everybody wants to hold dollars because of the economy. But likewise, when there's a crisis, the US dollar is still seen as a safe haven. So it ends up benefiting just as much from crisis or negative, when the world feels like it's scared or in trouble, than it does just as well as it does when it's, when things are really going well. The dollar tends to be weak, when it's neither crisis nor a very strong economy. Basically, and the reason for this is quite simple. The dollar is still, pretty much, more than, I think it's more than 60% of all trade still carries on in dollars, and the only one that's only other real currency is the euro, and that's only really within Europe. Between Germany, France, Italy, as they trade amongst each other. The rest of the world pretty much trades in dollars, and it's not that. For example, a South African clothing manufacturer here wants to buy, fabric from India in dollars rather than rupees. It's easier, it's cheaper. Everybody can talk in the same, it's almost like a language you can use. Okay, the South African guy doesn't need to know what the rupee is. The rupee guy doesn't need to know what the rand is. You can all price in dollars. So it's just for convenience. Nobody cares that it's dollars. It's almost like become the language of how trade works. If you want to think of it like your costs between banking are far lower in dollars than in other regions. So that's part of the reason why the US dollar has, everybody still needs to keep dollars because trade still works in dollars. But the other big thing, and this is I think where it gets more important, is so much of the world runs on in terms of dollar debt. If you're a bank overseas, so not part of the US banking system, but a bank in Europe or Singapore or wherever, and you want to give a loan to a customer in dollars, you issue that loan in dollars, you're essentially creating dollars. You're creating dollar debt. And that's called they call it hidden debt because banks do this, but they don't have to report it to anybody in the US. So it's more like unreported debt. And the scale of that debt outside the US. So first you got the bank, you got non-US bank debt, which is, as I said, that would be another bank. That would be a bank, say in Singapore or China or even Europe, issuing debt. And then you got shadow banking, which is any other institution that issues debt. The size of that is massive. It's $65 trillion. just to put that in perspective, global GDP is only at $104. And you can see that there, that your unrecorded dollar debt is more than double the size of recorded dollar debt, which is the dollar debt in the US. And when you have this amount of debt there outside of the US, those entities need dollars to be able to pay that debt off and to be able to settle their debts. So when you start getting, the world gets a little bit more nervous, more in crisis, the actual demand for dollars goes up substantially, and because they have to. So you can see that. So despite all of these reasons that, in a normal country or a non-reserve currency country like South Africa or anywhere else in the world, if we were doing these things like QE1, QE2, all of the pay, all of that stimulus that they provided for COVID, the bailing out of the banks when, Silicon Bank went under, all of that type of thing, they would normally weaken our, we'd see it in South Africa all the time. We'd see how it would weaken our currency. But in the US, despite all of that, their currency is still 20% higher. And that's just a result of the massive amount of debt that's held outside the world in dollars, and that requires other countries to, or other entities outside of the US, to keep having to almost suck up those dollars or hold the dollars regardless of, whether the dollars, looks like it's the financial fundamentals of the dollar. And you see it there. If we look at, wait, let me go back to you there. You can see the euro, that's been falling strongly against the dollar, and the big one over the last few months has been the yen. The yen has literally, broken through, in the last few years, it's literally broken apart. This is upside down because this is going upwards here as the yen actually weakening. The yen's broken, gone all the way past 156. It's lost almost 50% of its value against the dollar in the last couple of years. And so with all the fiscal and financial sins that the US has committed, everything that we worried about the Fed and dollar, the ECB and euro have, and the ECB and the euro, as well as the Bank of Japan and the yen, have done it, and done it far more already. And that's it. So it's very much the case is, as they say, the dollar is the least dirty shirt. You can see the US dollar here has basically risen against every currency in the world, minus the Swiss franc and the Mexican peso. But, because just so much of these countries, they just have so many debts in dollars, and they cannot, and if you have debts in a currency you can't control, you're going to weaken against that currency. So that's why we can have a situation where both the gold goes up and the dollar goes up. You must see what the gold looks like in, some of these currencies, and in South African rand as well. You can see there we've lost over the last couple of years, us losing 30% against the US dollar, but, add in gold that has now performed, or, even US equities. You can see why, like when we looked at the beginning of this presentation, just how much, the offshore investments have outperformed the local investments, taking just into account the dollar effect there. And, with the higher inflation now looking, with inflation looking higher for longer in the US, the US is now, they now took off a rate cut for June. And once they took the rate cut off for June, because the actual Fed, while they're not completely, I say they're not partisan, they don't care whether they're Democratic or Republican, but they're definitely political. They want to stay out of the narrative for the election. So if they weren't going to cut in June, that was the last real political opportunity for them to cut in June. Since they're not cutting interest rates in June, we're probably not going to see an interest rate cut in the US till well after the election. So that's still after November. Whereas the ECB, because, their economy is looking weak, there's, with, recession in Germany and and a lot of the other areas there, same with Japan, you're seeing this massive interest rate divide, which again is sucking in more and more capital into the US. And once again, that's wreaking havoc, as you saw in the previous slide, on all the other currencies. So anyway, so that was just to give you one idea of there. Another place that's really, so the dollar is strengthening against other currencies, but it's really weakening against other stuff, and stuff that is solid stuff. So whether it's specifically equities and companies that are doing well, but also, the actual physical stuff, which is like gold, and, the most used stuff of all, which is energy. Now, I wanted to talk about oil, but then I'd never get through the slide because I can go about that forever. So I want to just talk a little bit about how energy works and what we're seeing with energy, and also part of why I think energy is such a great investment going forward. The IEA even previously saw that pretty much it's just sticking on electricity for a while now. We were seeing a more than doubling of electricity demand by 2050. But over the last year, we've seen the world pretty much change with AI. I mean, it's growing at a massive rate. But here's what people don't realize, the interesting, what's required. And I mean, we all saw this when Amazon ended up buying basically a nuclear power station. All they bought a data center attached to a nuclear power station. But you need a lot of energy to be able to run these data centers. So you can see this is, by 2030, which is in the next 7 years, they're almost going to need to double, or more than double, the data center energy consumption, which is about 460 terawatt hours. To put that in perspective, South Africa only uses about 200 terawatt hours a year. So they are going to require 2 South Africas of electricity just for data centers over the next 2 years. And you can see there's been a lot of investment. I mean, tech companies are expected to invest over $1 trillion in data centers. Like I said, Amazon bought basically a data center attached to a nuclear power plant in Pennsylvania. And just to give you an idea, I mean, a ChatGPT request requires 10 times the electricity of a Google search. So AI is extremely energy intensive, and if you look at the ARM, that's a UK-based semiconductor manufacturer like NVIDIA and TSMC in Taiwan. They were saying that data centers could consume as much as 20% of all US power requirements by 2030. Today it's 4%. Now, that's on, but if you look at NVIDIA's projections, and NVIDIA's an interesting case because they are projecting massive growth going forward. I mean, you've seen their price, they're now they've been the big performer of the Mag 7. It's driven most portfolios' performances for the last year. But if what they're saying comes true, and if we believe the sales projections they put out there, they get it by 2030, there could be as much as 2,000 terawatt hours, which is the equivalent electricity demand for Germany and France combined. Now, in my opinion, that's never going to happen, which means there's no way NVIDIA can actually provide what they say they're going to provide, which is pricing to NVIDIA's share price, because there's no way you're going to be creating, and whole Germany and France in energy. But you might remember there's also a lot of technical innovation. These things will get more power efficient and things like that. But what's important to look at it from the investment perspective is you can't use renewable energy or data centers. You can't have a cloudy day, just make your cloud inaccessible. 3 days of rain or no wind, and suddenly you can't access you can't access your information anymore. Isn't possible. It has to be, it has to be consistent. That means you need power plants that provide what we call baseload power that's consistently on there. And there are lots of beneficiaries of that. Natural gas plants, especially in the US, will be the easiest to make because it only takes 4 years to build a plant as opposed to 12 or 13 for a nuclear power plant. Other beneficiaries will be the pipelines that will move natural gas towards those areas. A lot of the data centers are now being built close to where actual natural gas is. They're moving away from, from cities and actually moving to where the power is. And then you've got all of those, in terms of improving the grid, you're going to have massive copper demand increasing. So there's lots of places to benefit. But I still believe the best place that'll actually benefit because of the climate, our climate issues and things like that is going to have to be nuclear, and that is uranium. And look, I've been investing in uranium now for a couple of years because uranium's been in an interesting cycle there. There's been a huge lack of supply built for a long time. If you look at the uranium price as it's, over the last few decades, post Fukushima, there was a significant drop in the price as a lot of nuclear power stations got closed down. Plus, we also had the megatons to megawatts, where they were taking all the old nuclear weapons from the Soviet Union and converting the uranium in those, back into uranium that back into basically de-enriching it so you could use it actually in nuclear power stations. So there was this massive supply of uranium on there, as well as a huge drop in demand. And that caused the uranium price to drop from 135 all the way down to about 25. And then over the last couple of years, it's now increased all the way back to 88. And all of that, because there's been no investment in it. There's been a huge lack of supply now, but demand's been increasing dramatically. I mean, as you can see there, we've had over, well, I think there's currently about 152 reactors, if you include all the ones that are being I'd say refurbished or getting life extensions and things like that that are now being there, because we had the whole COP14, COP24 climate goals where they said they want to double nuclear capacity by 2050. But if you actually look at this, I think was first produced by Cameco, and then one of the big uranium producers. So if your base demand is happening this, so that was just if we were going to already have nuclear carrying on just with normal, the nuclear power stations that we're currently running. We were going to run out of uranium. There'd be a huge supply deficit. But now where you've got the high demand case where you can see all of the new uraniums coming through, you've also got, looks like, especially with, this is even pre-data center, looking at the data center demand that was going to come this way, but just trying to match the ESG goals from the climate by 2050 means you need to more than double uranium production. So because, as with all mines, it takes a long time to get a mine. It takes many, many years first to get the mine operational, do your exploration. So it means we've got a long time to go before we'll actually get that. That can generally result in a huge price spike. And if you look at the last time the price spiked, back in the commodity boom of, in the mid 2000s, the uranium price went up, almost 2,000%. And even today, just to get to that inflation adjusted would be around $200. It's already run quite nicely to 88, but the odds are it's probably going to break the 200, and possibly even more, because back in the early 2000, in the mid 2000s, we didn't have, uranium wasn't in deficit in terms of supply. There was still adequate supply for uranium at the time. So now with the lack of supply plus all this huge demand, the uranium price really looks like something that can be, I would think, the biggest beneficiary of, this energy deficit. Like I said, natural gas will do well too. If they're going to have to build natural gas plants, I'll still think the natural gas price in the US will move forward from between $2 and $3 to between 8 and 9, which is a big run, but I think that'll be dwarfed by what you're going to see in the uranium space. And once again, not just the physical uranium, but you can see there that uranium equities have also significantly outperformed uranium. So for those people that want to take even a bit more risk in their portfolios, uranium equities are a great place to take bets. It's pretty much where, like I said, well, as Alex was saying, take risk. That's where a lot of my personal money sits, is uranium equities. But then also one other thing that last week, which is why I'm bringing uranium up so much today, is there was a big news last week where the US banned the imports of Russian uranium. So that became official last week, Wednesday. At the same time, they provided another 2.7 funding for supporting the US, $2.7 billion for support. So that's to build uranium re-enrichment plants. Both of them now are likely to, well, I think it's going to be a catalyst which will see uranium do its next bull run up. So I'm very excited for uranium over for the next few months. So anyway, I could carry on talking about this forever, and we're running out of time, and I've got to give everybody else a chance. So I'm going to have to stop now, but hopefully I'll be back soon. I can get into a lot more detail about lots more of the stuff. Thank you.
Carl, thanks very much for that. Quite an in-depth look at what's happening with regards to energy, and it's quite interesting. We've had a huge amount of questions that have come in. So Carl, if you can stay with us to the end of the presentation, then hopefully you can answer some of those questions together with Geoff and Emilise. So Geoff, if I can hand over to you.
Great, thanks, Alex. I am, unlike Carl, I'm not running the slide deck, so I'm going to be relying on Cameron to run the slides for me. So every now and again, you'll just hear me say, Cameron, next slide. So as usual, at the quarterly feedback sessions, we always like to remind our clients around our investment philosophy. And the reason for that is that, our view is that your investment philosophy defines the framework with which you will try and remove emotion as much as possible out of investment making decisions. We always say, emotions are potentially the enemy of good decision making, because often a logical decision might emotionally be quite tough. That's like when a share has just run and done very well, and you need to take some profits. Emotionally, that's quite a hard decision because you're anchoring to the recent performance of that share and you think it'll keep going up. And likewise, sometimes a decision to make an investment into an underperforming share or asset is also quite hard, because emotionally you could be challenged. It would be emotionally challenging to do that. So as a result, we have our investment framework, and it really just tries to govern the way we see the world. And you will have seen these slides before, and I'm afraid you're going to see the slides again in the future. But our framework really revolves around how do we want to create long-term outperformance. And there's a few simple rules that we follow. The first one is that you want to win by not losing. And win by not losing means is you just want to avoid the bombs. And remember that risk is often symmetrical. So if something's done really well, or it's done really badly, there's a chance that, because risk is symmetrical, that something that's done really well means that it could also risk being doing really badly. And so as a result, we've got to be tempered, not just win by not losing, by avoiding the bombs, but don't get sucked into just backing the winners, because it's very hard for an asset to keep rising and doing well over time. There are bubbles and emotional bubbles, and that leads on to obviously our second approach, and that is just reduce single factor bets. So what do we mean by single factor bets? It's not just about betting the portfolio on one asset. Cole makes a very good argument potentially for investing in gold, but that doesn't mean you want to go and put your whole portfolio in gold. But there's a more subtle single factor bet, and that is that you might end up building a whole portfolio of assets. And we always used to say in South Africa, if I built a purely rand hedge equity portfolio, while I've got a diversified basket of shares, in fact, there's one underlying factor in that portfolio, and that is that you're betting on a weakening rand. And that may or may not be right, but what you've really done is you've taken, you removed the benefit of diversification, and that takes us on to our third aspect, and that is be careful of unintended single factor bets in your portfolio, and you do this by ensuring that you've got broad risk exposure across the portfolio. And that you're not creating one factor driver in the portfolio. If you get that factor driver correct, you'll be a hero. But if you get that single factor wrong, you're going to lose a lot of money for your clients or for yourself. And then obviously the final approach that we see in this is really if you have built a diversified portfolio, you diversified your risk exposure, you removed excessive exposure to single factor bets, you're trying to avoid the bombs. Really what you want to just do is all of that leads just to small, consistent performance over time. And if we think that you can just consistently just outperform a little bit, and you're going to have periods where you underperform and periods where you're going to outperform quite a bit, but if you rather stay consistently, eventually that does lead to long-term outperformance. So Cameron, if we can move on to the next slide. However, within that investment framework and the way we see the world, there is one free lunch. We're talking about there's no such thing as a free lunch. In fact, there is one free lunch from investing. And that is setting up your strategic asset allocation. And we'll talk about that in a moment across the Cinnabar range. But essentially over long term, and we've experienced this both anecdotally, but empirically, this has also been shown through research, in that long-term performance, call it nearly or just over 90% of your long-term performance is driven by your strategic asset allocation. How much you have in what I'll talk about is growth or conservative assets or defensive assets. And within that, what basket of assets that you put together as a fixed asset allocation. All the rest of the work that we all try and do only counts for 8.5%. So of your long-term performance. And that is whether it's the security selection, spending all this time talking about should I buy Anglo-American or Billiton. That just kind of discussion only over the long term counts for 4.5% of your returns. 2.1 and 1.8 really just talk about small asset allocation tilts. Should I have a little bit more in gold, a little bit more in property, a little bit more onshore, offshore? So amazingly, all the work that most of the investment world does in terms of active management only adds 8.5% of long-term performance. And all of it is determined by your strategic asset allocation, which talks about that is probably the single most important thing you need to get right in your own investment allocations or with your financial advisor. Cameron, if we can go into the next slide. So how do we implement this framework? Well, in our world, what we do is we break assets into what we call 3 types of asset classes, if you want to call it. And this is the initial part of your strategic asset allocation. As part of this 91% of value add. And we think there's 3 types of assets that you get. Defensive assets, which don't go back in value, but give you a little bit of income. And that's sort of less for money in the bank. It's not risk-free, but you're buying asset. You're not risking the capital value, but you're getting an interest yield. You then obviously get your growth assets, which are more equity-like, which have the ability to grow with inflation or hopefully outperform inflation. And then the other asset class that we look at is flexible, where people are switching between asset classes, or they're actually trading the market, or they're going into interesting opportunities. And so we break the world, and across our range from income up to balance plus, you can see that as you go and try and achieve more long-term returns, you have to have more exposure to your growth assets. Cameron, if we can go to the next one. So what you'll see in the following slide is what we call the peeling of the onions, as it were, in this in the structure. So when we look at our portfolio construction across our various funds, we start off with the first question, the strategic asset allocation for a fund. How much do you want in defensive and growth? That's the first layer of onions. The next layer is your broad asset allocation. So within your growth assets, how much might you have, for example, in equity, or other asset classes? How much might you allocate to a bit of flexible? How much might you put into real assets, real estate, for example, property? How much would you put into fixed income as part of your defensive? So that's the second layer of the onion. The third layer of the onion is within each asset class, within equities, what equities do we get? Do we have South African equity? Do we have developed market equity, emerging market equity? Within property, what kind of property? And then finally, the last layer of the onion in terms of our diversification is to say, within each of those, within SA equity, what asset managers will you have to try and pick those stocks? Or would you buy an index fund or a combination of a tracker fund? And so through that allocation, we aim to add value into the portfolios. But the interesting part, oh, sorry, Cameron, if you can go back, the interesting part is the stuff on the left, and really it does talk about the first, second, and mostly the third slice of the pie here, or the third layers of the onion, really are that 91.5%. If you get that right in the long term, you're set. All the stuff on the right and everything else really actually doesn't count for a hell of a lot in terms of your long-term returns. But you still need to do it, and you still need to focus on it. So with that backdrop and reminder of what we do, let me talk you through the portfolios and how the portfolios have done in the last quarter, and then I'll also expand on how they've done in the last few years as well. So in terms of the last quarter, 4 of the funds have outperformed, so we're quite comfortable with that. And 2 of the portfolios, the income fund and the stable fund, are slightly behind the ASISA peer benchmark. And the other funds, the more aggressive funds, have done well. And I'll unpack, well, in fact, we'll go straight into just unpacking why the income and the stable fund have underperformed a small amount over the last quarter. So starting off with the income fund, there are 2 reasons why we're slightly behind on the income fund. The one is that our managers have gone, an income fund, you either buy short-term deposits at the bank or short-term investment notes, or you might go slightly longer and buy slightly longer dated bonds to pick a nice yield. Now, as you know, if you go into the bond space, you might get higher yields than putting your money into, say, short-term fixed deposit, but you also might suffer a little bit of changes in the value of capital. So this portfolio has a slight longer duration. In other words, the managers have gone and bought some more bonds in the portfolio, a small component of the portfolio, because they could pick up yields in the range of 13% in our long bond space here. And we think that's a very attractive yield, and we're comfortable with that manager decision. However, if you recall with bonds, if bond yields rise more, you could lose a bit of capital. So while at that stage, we're currently comfortable with the fact that they've locked in good bond yields, bond yields continue to rise slightly, and as a result, there was a small pullback in the valuation of the portfolio. So that's the reason for the slight underperformance there. The other reason for the slight underperformance is the fact that two of our managers, MyPlan and Saffron, had a small exposure to taxi bridge finance. As you know, that entity, they impaired those assets. They've side-pocketed them, and there's a small capital write-down on that portfolio. In terms of the stable fund, again, this is slightly behind peer group. This is driven, again, primarily because of the impact of the income fund exposure, in that the managers have taken that slightly longer bond position. We think we will be rewarded, or they will be rewarded for that. But we're very comfortable with that. In terms of the other asset allocation of the stable fund, remember the stable fund does have small allocation to some growth assets. And in that fund, we've been increasing our exposure across all our portfolios as we communicated. We've communicated on the last two or three feedback sessions. We've been selling down South African equities in a considered fashion and raising offshore exposure, basically selling out of the SA top 40 index funds and buying global MSCI World ETFs. Small change in the portfolio here. Cameron, and you can run through the others, you'll see the same theme goes through all of them. In terms of the balanced fund, again, nice outperformance of both the benchmark of inflation and the peers. And over the last quarter, we've been rising and raising our offshore exposure as well in the portfolio. Just again, incremental sales, then using Rand strength. Balance plus fund, again, nice outperformance of peers and inflation, the benchmark. And at the same time, you can see the theme here of reducing SA equities in favor of global equities. And then again, in the flexible fund, same story. Again, nice outperformance and increasing offshore exposure at the expense of local exposure. In terms of our worldwide flexible fund, also comfortable performance. We haven't made any changes in that portfolio over the last quarter, and as we're comfortable with the current fund structuring. Great. So just to unpack the theme that you've seen in the portfolios with our local portfolio changes, again, across those portfolios, the move is to take more offshore exposure. So to give you a feel here in our local portfolios, this is where the red chart shows you, sorry, the chart show you our exposure to SA equities, just using the balance plus fund as a proxy, and offshore using the balance fund as a proxy. So starting at the end of last quarter, you can see that our strategic asset allocation, our balance plus fund, is 35% allocation to South African equities. At the moment, the fund, well, you'll see now the fund at that stage had 55% exposure to South African equities. And conversely, our strategic benchmark for global equities was 38%, and the fund had 20%. So Cameron, if you can move just through the next slide. So you'll see that what we then did by the end of quarter 4 is we had reduced the exposure. We'd shifted assets offshore at the expense of South African equities, and we bought global equities. And Cameron, you can just move forward again. And again, we then did this in the last quarter. And you can see at the moment now we are at 50% in South African equities, down 5%, and we've been allocating increasing amounts of offshore. That strategy will continue in the next month. and will actually accelerate. You don't want to go and wholesale move portfolios. Remember, it's very hard to call the rand, and you might have a short-term or a medium or long-term view of the rand. But rather than do a wholesale move on the rand, one of the ways that you want to manage risk in the portfolio is to slowly change asset allocations. I mean, I remind you that when we initiated this process, the rand was closer to 20 rand 50, whatever, to the dollar. If we had at that stage just dumped the entire 15% exposure in South African equities into global equities, we would have paid a lot more than what we've been doing through the bleed. But likewise, while that slow process has worked in our favor, it can also work against you, because the rand could have weakened out. But our view at the time was that there was going to be nearer term rand strength. And the sale of within the sale of South African equities, we've been allocating that to two offshore portfolios. The one is just an MSCI World ETF. That's a tracker fund for the MSCI World Index, and that excludes emerging markets. So we've also been buying a little bit of emerging markets as well via the Satrix MSCI Emerging Markets ETF. Thanks. It's quite. I feel like I'm in a self-driving car, because the slides are just moving magically ahead. In terms of our global balanced portfolio, again, ahead of both the peers and inflation, we're not anticipating any changes in the portfolio here. But I do want to just mention to you, we are cognizant of our risk exposures. Obviously, equity makes up the largest component of that portfolio. And when we look at the exposures in that portfolio, we look at not only the direct exposure. So, for example, in that portfolio, there's an overweight to the US, but not dramatically so. We look at it across the benchmark, across all markets, but we also look at the revenue exposure. Remember, it's not just where the stock is domiciled, but also the revenue that you find in the portfolio. So interestingly enough, while the portfolio might have had in equities 60+% exposure to the US, from a revenue perspective, even a company's domiciled in the US, it has global revenue. So we do track the revenue in those portfolios, and we're comfortable with these allocations at the moment. I think I'm waiting for two more slides or one more slide. So how does that all flow through into I've spoken about our near-term allocations, our near-term performance over the 3 years. How does that translate? Again, across the portfolio range, you can see that from a risk profile perspective, they are behaving appropriately. We're also pleased to say over 3 years that all the portfolios, barring the income fund, are in second quartile. Income fund is third quartile. Part of that is just because of the recent underperformance that we've seen in the fund because of the long duration position in the portfolio. But again, as we believe that we get rewarded for that position, that will impact and positively impact the performance of the income fund. And so how does this look in terms of the general risk profiles? So you can see here, this is the scatter plot of all the Reg 28 peers in the space here, the Reg 28 peers that we're trying to collect and build an outperformance of. And you can see here that the Cinnabar range we're very pleased with and comfortable with the way that those red dots are sitting in the right risk profile trajectory, but at the same time they are sitting above the peer clusters. And so as we say, we hope that we've taken very complex issues and simplify them into a very understandable and manageable framework. And I think that's my section. I'm going to hand over to Zahid to introduce our guest.
So much. Thank you, Geoff, and for all this. I think the information that you've shared is extremely insightful. But I have the pleasure now to introduce to you our guest speaker, Emilise Rautenbach, who is a behavioral consultant and coach. Now, Emilise completed her BA degree and diploma with distinction at the University of Pretoria. And after spending 4 years of teaching, Emilise decided to make a few career changes. In 2003, Emilise started her own business called Dynamic Action to Rebuild and Enhance. Emilise has received many certifications in Brain Gym and completed leadership courses of John Maxwell and the NBI course of Dr. Kobus Neethling. Emilise completed her honors degree in psychology with distinction and her master's degree in research psychology with distinction also. Emilise is an international coach with certifications that allow her to speak with an immense amount of knowledge on the topics that she does. So let me introduce to you Emilise Rautenbach.
Hello to you all. I just want to make sure, can you see my presentation, Zahid, Cole?
Yes, we can.
Okay. So thank you, Cameron and Zahid, for inviting me to do this talk today. And I hope that all of you can take this information and use it as a tool in future when you deal with clients. So I'm going to talk more about behavior. And the moment that we talk about behavior, the aim for this talk is for you to start understanding what is the root for the decisions that people make. Because all this economic information is wonderful, but at the end, it is either you or the client that needs to make financial decisions. So if you can understand the root of decision making and you can start managing that by taking control over it because you understand behavior, it's going to help you tremendously. So therefore, we all know that people act differently and react differently. And the reason for that is how we process information. So as I'm sitting here and explaining the information to you, all of you have got a certain experience about a Teams or a Zoom meeting. So what we all do is, I'm going to explain it with this picture. Think of this picture as if this is the brain and you cut it through and you turn it like this. So it's the inner part of the brain. So you are busy listening to this information and viewing the presentation. But you take that senses information, you take it through the brainstem to the limbic system of the brain. And this is where your limbic system is situated. And that is the emotional part of the brain. So what I'm actually saying is that the moment that you absorb information, you will firstly process that information emotionally, which means that in the brain, this interesting thing happens. We use the current situation, look at the information we can gather, and then we take all the experiences that we had previously about meetings, for instance, and we think of how did I feel with all or in all the other meetings that I attended in the past. That is your perception. So your perception about a current situation can be either positive or negative. It can't be both. So therefore, the moment that you have a meeting with a client and this client had a bad experience in the past with either a financial advisor or with investment that went bad or whatever, they will approach the current meeting negatively because the emotion in their perception is negative, which means that this interesting thing happens in the brain. The moment that we think negative, information flow in the brain will be very slow, which means that you will see, but you won't be able to recall what you saw. Or you will hear, but you can't recall what you've heard. So when you get that information through your senses, it feels like you do understand, but it's not in the memory because the brain process that information very slow. The opposite happens when you've got positive information flow. The moment that you think positively, it's quick information flow, and you get that information in the memory and you can recall it. So that is what we need to remember when we deal with clients, is that if we realize that this person in the attitude is very negative, we need to stop there. We can't try to explain something to this person or want them to change the investment or to make a choice. They won't be able to, because of the negativity in the brain that will influence the ability to process information at that stage. So what we found in behavior is that the moment that we realize this person is in an emotional space in his decision making, the best way for you to get this person into cognition, which means that he will start reasoning about that information, is to start asking questions, not giving information, but ask questions. And I'm going to show you how the brain works in the thinking so that you can ask the right questions and that you can pinpoint through question and answers how this person thinks. And then you can take control of the whole conversation. Even when you send emails, you need to think about these questions that I'm going to talk about so that you can ask yourself these questions, and do people then have the ability to answer these questions in the email so that you can lead them out of emotional decision making into cognition so that they can start reasoning about stuff. And that is also the best way of making decisions if you are in the cognitive part of the brain. So now I'm going to talk about this part of the brain. When we think about thinking preferences, all of us think differently. And the reason for that is from the time that you were born until about at the end of grade 7, we all look at our environment, our teachers and parents and siblings and friends and school and language and culture, and we take that cues of how these people think. We take that and then we add to that our genetical makeup. So it means that 70% of the environmental cues we use, and then 30% of our genetic makeup. And with that combination, we lay down a foundation of how we think, a pattern of thinking in the brain. So what I'm talking about is, let's think that we take out the brain, we flatten it, and we divide it into 4 quadrants. So now I'm gonna just talk about 4 quadrants. Actually, there's 8 different spaces in which we can think. And all of us use the whole brain. So all of us use all those spaces in the brain when we think of or when we make decisions. But I've divided it into 4 quadrants for us to use this information as a tool in decision making, or when we deal with clients. So what we need to understand about how people think and the pattern of thinking and how we differ is that some people can start with their thinking in this quadrant. And then this specific person's pattern of thinking is that he goes from this quadrant to that one. And then he goes to this one, and then to that one. So it means that for this person, the flow of thinking will happen in a zigzag in the brain. For another person, it may be that that person starts in this quadrant. Then the second preference is this quadrant, then that one, then that one. So that will be a circle flow of thinking in the brain. but the other person may start in this quadrant, moving to that one, then to that one, then to that one. So this one makes a Z in the pattern of thinking in the brain. That is what we need to understand. And that is why people in their thinking differ so much. But what me and you will do is the moment that we think about something and we want to make decisions, we expect from other people to think about the world and the current situations in the way we think, and we are used to see the world. And if we start listening to other people, start asking questions, summarize for that person what he just said, we will get to a point where we can pinpoint what is the first preference of thinking of a person. And the moment that we can meet the need of that first preference of thinking, we've got that person on board and we can lead them into the correct decision making. So what we need to understand is, let's say that this quadrant's thinking, let's name it L1, and this is the realistic and analytical thinkers. So yes, temperament and personality also influence behavior, but specifically in financial behavior, our thinking is the main thing that determines our decision making. So therefore, if we realize that if a person thinks firstly in the L1 quadrant, the need for information of that person is that he needs clear-cut information. He needs exact info, to the point facts. He needs to get not too much detail, because those people will stop you and they will say to you, no, get to the point. What do you actually want to say to me? If you go into too much detail, they will verify your information always. They will go and do research. They won't believe you at first. Every time when you share information, it needs to make sense for them. They need to logically be able to explain it to themselves. Then they do understand that information, and then they will be able to make a decision. But they won't try something. They won't even take a risk if it doesn't make sense, if they don't know all the facts, if they don't have all the information that is necessary, not detail, remember, the basic facts. They look at information in the big picture. So for them, you mustn't waste their time. You need to pinpoint the facts and then just give them that information. They like challenges, but the challenge needs to make sense, and they won't try something or take a risk if there's a slight possibility for them to lose money. Then they won't try it out. Usually what I find is that people think in this quadrant, with money, they think before they spend the money. They rather will save money. So they are very good investors. And I find that usually in the financial environment, you will find L1 thinkers. So then when we go to the L2 thinking preference, if a person starts with his thinking in the L2 quadrant, it means that they are focused on very much detail. So remember, where the L1 thinker will focus on the big picture and then add their own detail that makes sense and that's factual and logical. These people in the L2 quadrant can't see the big picture if they don't have all the detail available. So these people are the people that don't want to make decisions quickly. If you give them only the basic facts, they ask questions, they can't understand because they can't see the big picture. They need all the detail when they are need to make a decision. They will always compare the pros and the cons. They will even compare this investment with another investment. They will go through all the detail, even the everything that's written very small. They go through everything before they can make a decision, because by getting all the detail, they then have the ability to see the big picture and what we actually are aiming for. So therefore, for these people, they need the how behind the steps that they need to implement. So very slow decision makers need to plan, and they hate change. So if there is, in the current economic climate, quick changes that we need to implement, for them, it's going to be very difficult. And for them, they need to plan before they will be able to even make a decision of change, because they like things being in the way they know it, their routines, their ways of doing things. They are also very critical when you come with new ideas. They want to know, how are we going to implement this as step by step? You need to explain that to them. So what I usually find is that a lot of times, people that's in the financial environment, they think in either the L1 quadrant first or in the L2 quadrant first. So if we can identify a client by asking questions, remember I said, when you need to take them out of emotional thinking and decision making into cognition, you need to start asking questions so that you can help them to start thinking about and reasoning about information rather than stay in the emotional space in the brain. So if you start asking questions to determine whether we work now with an L1 person who needs a lot of facts and logical explanations, or are we dealing with an L2 person that needs all the detail, step 1, step 2, step 3, and the how we are going to implement this? We start asking the question for the L1 people, what? So the what questions, you can even before an appointment, or before you write an email to such a person, or when it's the first time that you see this person and you need to talk about investments, you can ask the what questions. What do you know about? What is the facts around? And so forth. And then by doing that, you help that person to start thinking in his first quadrant, and you start focusing on meeting that need. If you realize that the person is an L1 thinker, just give him the basic facts. If you realize that the person is an L2 thinker, ask a lot of questions. How do they think they will implement? How do they think they will start with the investment, or how do they experience it or see it? You ask the how questions for the L2 person. So I want to ask you to, as I'm explaining this, think of all the clients that you have and write down the names of the people. If you can identify this person is definitely an L1, or this person is definitely an L2 thinker, then it helps you also in the information that you share with that person. Because if you don't give the L2 enough detail, they won't make a decision. If you don't explain the basic facts and start giving too much detail to the L1 person, they won't make decisions, and they will verify your facts. So then the R1 thinker, that is the people that think very strategically, and they are the Imagineers. So when a person starts with his thinking in that quadrant, it means that he sees information in the big picture. They hate detail. They don't want paperwork. They don't read through their contracts. They always need quick decision making, challenges. They are energized by risk taking. They don't need all the factual explanations and logic behind things. If it's interesting, they will buy into the dream and into the end result, and they will take the risk and go for it and try it out. So these people are usually the ones that make quick changes and love change. So they won't oppose economical change. They will rather take risks and make very quick decisions and move quick from one thing to another. And therefore, if you are a financial advisor to such a person, you need to keep an eye on that person. He will withdraw money for no reason, and sometimes they make very weird decisions. So that is your R1 thinker. And financially, I don't find them also a lot of times in the financial world, because they are very imaginative in the way that they experience the world, and their perceptions is also very imaginative. So that is your R1 thinker. For them, it's very important to understand why, the why behind information. If they can buy into the why behind it, you've got them on board, and you can do whatever you want. They will back you with that. So if you are such a thinker, it means that you are a go-getter. You like the risks that you can take. It's always a challenge. Change it actually energizes you. So then we've got the R2 thinkers. Now your R2 thinkers is the people that focus on relationships. So for them, relational life is more important than anything else. So they are the socializers and the empathizers. For them to make financial decisions is very, very difficult, because they will always make a decision according to the information of others. They are team players. They want the loved ones to agree with their decision. So usually you will find, let's say you are busy with a client, it's a married man, and he needs to make a decision now. You will hear from the R2 thinker that he will say something like, okay, I understand what you explained, and thank you for explaining this to me, but you know what? I need to talk to my wife about it, and let's then talk again. So he wants to incorporate her thinking and the way she sees things before he makes a decision, specifically financial decisions. So a lot of times we will find that these people want to work together in their decision making. Let's say you've got a single person, not married, not in a relationship, and you are busy working with this client. You will find that this person will constantly ask you, what do you think about that? Do you think this is the right decision? Let me just ask. Just give me some time. And then this person will go around and ask a lot of questions to other people to see whether this decision makes sense. So they rely on others and the information that they can get, not always on logical explanations, not always on the facts like the L1, not always on the detail, but according to the relationship and the trust that they have with the people that they trust to give them the right information for their decision making. Now, for them, the who question is very important. Who am I going to influence when I make this financial decision? Who will benefit? Who won't benefit? So the who question is very important. So when we summarize this, we need to understand that the best way of approaching people in investment or in financial decision making is to pinpoint how the first preference of thinking is of this person. If you can pinpoint that and you can meet the need of that way of thinking, you've got them on board, and then you get their trust by doing that. So what I will recommend is that we always start conversations by asking questions. And the best way of starting a conversation, or when you need to explain any change that you want to implement, or when you want anything different from the way that they are used to, how you deal with them, you need to start with the why question. So ask the client, why do you think this is important? Or why do you stay with this investment? Or why? The why question, they need to answer that, not you. They need to answer that. And for you to intentionally listen, I will recommend that you ask permission before you start with a conversation. You ask permission, may I just jot down some words so that I can intentionally listen to you and that we can start making the right decisions. So usually people get tremendous respect if you ask permission to jot down information. Sometimes you have only your cell phone available. Then go to your notepad and jot down only words that will remind you of what this person is saying. That helps us to really listen intentionally. And then we listen for cues. You listen to how this person explain the why. So if they explain it just by focusing on the end result, it will be wonderful to reach that dream. Oh, I'm going to be rich when I've got the payout, whatever. You realize, you will immediately know and pinpoint this is a R1 thinker. So if we can get the R1 on board, we win all the way. Then you ask what question. So what you know, what is the facts that you've got available? What makes sense to you? So ask the what questions to pinpoint how the people think. If you realize that this person, but with the why question, in the answering, focus on facts and reason about it and explain to you the let's say something that makes sense, and they use a lot of times the wording, it makes sense, then you know it's a L1 thinker. So then you ask what questions. Then you start asking how questions. How will you go about? How do you think we need to implement it? And then you ask why questions. So the who question. So who will be influenced by these decisions? If you can keep this in mind, it's a wonderful tool for us when we go into any kind of conversation and we start with why, what, how, and who questions. And we can, by doing that, realize what this person think and how this person think and what makes sense to this person. And then every now and then, we summarize from the words that we jotted down. We look at these words and say to the person, okay, so do I understand correctly according to what you are explaining to me or sharing with me? I understand. And you use these words and you try to summarize what you understand of what this person is saying. Because remember, you think in your own preference and first preference. So sometimes people, if you are a first preference thinker in the L1 quadrant, people in the R1 quadrant will irritate you. So now you can't focus on the irritation. You need to focus on what is the facts so that I can pinpoint how I need to talk to this person and how can I meet the needs of this person. So that is what I will recommend. When you have summarized information for the person, you ask them, is that how you see it? Do I understand you correctly? And then when they say yes, you carry on asking questions. When they say no, you ask them, okay, explain it again so that I can get on the same page as you. Then if you go into conversations, go into it with the expectation that people will just hear nothing and remember nothing. If you go into the conversation with that kind of expectation, you will, by doing that, remind yourself, ask questions, summarize, make sure you do understand, and ask questions. And then remember, perception of people will differ. So it means that you think that you explained information in a certain way and you see it in a certain way, but others will see this picture or another person will see that picture and it's actually the exact same information that you have shared. And that is perception and due to perception. So therefore, if we can get into the mind of the client by asking questions, we help ourselves and the client. But now the big thing, especially with the elections that's coming, people downshift. And we need to understand that downshifting means due to quick decisions, due to stress, the brain sends information to certain parts in the brain, which means that we start to downshift in the brain. It means that at the end, you only use 1/8 of the brain to be able to make decisions. And that 1/8 in the brain, for every person, it differs where you focus in your functioning. And that can cause blocks, brain blocks, which means that if you've got an eye block, and people send you an email and say to you, read through that email, that is the information. You won't read it properly. You will make mistakes. You won't understand it properly because you've got an eye block. Visually, you are blocked out. When you've got an ear block, it means that auditively, you are blocked. So sometimes people will share information with you and you can't remember. You've heard, you know they shared it, but you can't remember it due to that ear block. And that is all due to stress because we revert to use only 1/8 of the brain. We need to understand that. And that is stress functioning. And especially when people need to make financial decisions, they will revert into that eighth of the brain. And how we can help these people is by asking the questions as I explained, and then remind ourselves that that person may have an eye block. So visually, I can't just think that people will read everything. I must make sure that we read it, I explain it visually, I explain it auditively, and then help them to make a decision to go into the action, because our feet works with the space in the brain that help us to make decisions and help us to take an action. So if you've got a foot block in the brain due to stress, it means that you can't go into action, so you won't make the decision. There's still a lot of stuff that I can explain to you about behavior and human behavior. But the main thing that we need to remember is, if we can go into conversations, listen carefully, summarize what we understand, and constantly ask questions in the format that I showed you, I think that we will rather win than lose in the whole process. If you want your own profile done, that is my information. You are welcome to contact me. So with that, may God bless.
Emilise, that was a fascinating presentation. Thanks so much for it. As you're going through it, I mean, it's a great lesson on how to communicate. And I realized I've been communicating with Natalie, my partner,
Yeah.
probably completely incorrectly for the past 17 years.
Yes. Yeah.
But I mean, at the heart of all of this is really to help our clients get towards the outcome they want to get to, and behavior dictates. It's much more important than skill with regards to finances. People's behavior is far more important than skill, and if we can help have the conversations in an effective manner with our clients, we'll hopefully get more clients to follow the right behavior, which will help get them to a far better outcome. So yeah, this is really useful. I was those two quadrants, if you could share those with us, those would be really useful, because I was busy jotting down notes, but then I got caught up in my own mind and I forgot to carry on jotting.
Okay.
That was a great presentation. There are actually a couple of questions for you on the chat. And there was one question in particular: how do you handle a client that drifts between those segments? So someone's probably not only R1 or L1, they're probably a combination of L1 sort of dominance and then R1 sort of not dominance.
Okay. What we need to understand is that all of us have a certain pattern. So remember I said that we make up that pattern, that foundation of how we will think in the brain, and we all think in all quadrants. But what we need to understand is that in conversation making, we all need the first preference of thinking to be met. So if we can deal with that, a person, doesn't matter where he goes from there, the second dominance or the second way of thinking. If we can meet him in his first quadrant of thinking, we've got him on board. And then by asking questions constantly, the moment that you realize, oh my goodness, but I gave this person all the facts, all the reasoning behind it, basic facts, because I thought it's an L1 thinker. And now he reacts in a way that maybe it's R1. Then you again start asking questions. Okay, so why do you say this? Or why do you interpret it like this? So you always start with the why question, then the what, then the how, then the who. And you get the people on board as you explain, because you will react also on their answers. And you will hear how they think, and you can then build on that. Does it make sense?
Yeah, that makes complete sense. I like that structured methodology.
Yes.
You've got to meet people where they're at rather than trying to force them to be what you'd like them to be.
Yeah, yeah.
Thanks so much. If I can ask you to stay on, there might be some more questions that come up, but Carl, Geoff, and Cam, perhaps you'd like to come on as well. Just there are many questions that have popped through, and I'm going to see if we can address all of them. My closing thoughts are fairly straightforward. We've got so much going on in the world. It feels like the world's in turmoil, and it feels exceptionally complex. And just know when all this turmoil is going on, it creates an enormous amount of opportunity. And that's really what our role is. Our role is to take all this complexity and all the opportunity that is meshed within this complexity and put it into 8 very, very straightforward and understandable packages. And those are the portfolios. And each one of them is very well diversified and aims to deliver predictable performance. And as you can see, it's working out very nicely. Whenever I'm sitting with the clients, the only thing I look at with regards to portfolios is, have we beaten the majority of all peers? Because if we've done better than the majority of the peers, I know that our clients on average are doing better than most other clients elsewhere. And I'm very pleased to see that we are just about in all cases in second quartile, so top half of all funds, which is quite gratifying. Right, so let's get on to some questions, and there's one that comes in from Dan and Carl. I think it's towards you. So reflecting on the past decade, what have been the most significant economic trends and shifts in the USA, and how have they shaped the economic landscape? So that's a question that I know you could answer in 5 hours. I'm going to ask you if you can answer it in 30 seconds.
Okay, well, I think the biggest one was what I mentioned, is the low interest rate environment the US had, where interest rates were, close to zero. So that allowed, it really basically dropped the cost of capital so low that there was massive amount of spending, both in, terms of creating, huge innovation, in terms of a lot of the high tech shares, the tech share stuff, but on the same cases, a lot of bubbles in assets that just benefit from liquidity, whether it's cryptocurrencies or housing bubbles and things like that. So that's probably, if I have to say, the biggest single trend going through there. And a lot of that's resulting in a lot of the things I was talking about now, which is the end result of that low interest rate environment. Because it's been around for about a decade, we've come used to it, but it's more the anomaly. I think that's what people need to or what's most need to be understood, is that, zero interest rate environment, or that super low interest rate environment, was the unusual environment. Sitting here at 5% and things and high interest rates, that's the more normal environment. So it's getting back to the normal environment that is the big adjustment we need to make now.
Thanks, Carl. Then there's a question that I'm sure is on the lips of each South African, and this is from Bernard. So with the SA election looming, how might local equities respond to different electoral outcomes, and what sectors or companies could be particularly affected, presenting opportunities or challenges for investors? Yeah, so who'd like to take that one?
Okay, well, I can chat about it a bit. I mean, there's essentially 3 scenarios you're going to have, which is, based on the polls, is how much does the ANC lose by or not get below 50%. If it's only a small amount, they can do a coalition with one of the smaller parties that doesn't make too much of a difference, and then we pretty much carry on as is, which is kind of going nowhere, slowly, and hopefully something will improve rather than going the other way. But that's pretty much the ANC, only being over 50 or slightly below 50. If they're medium below 50, in the in the mid 40s to lower 40s, then it can go in two directions, which is, I almost say, the bull case or the bear case. That means they're either going to go with a DA coalition as the positive case, or an EFF MK coalition as the negative case. So in the positive case, that would result in significant strengthening of the rand. Great for South Africa Inc. shares, such as banks, retailers, things like that. Really not so great for rand hedges. And you'd see, the rand would really get strong. Very, very, I mean, I wouldn't be able to say exactly what levels, but probably well below 17, maybe even 16. Even more so if it's a really bull one, because our stock market is looking at extremely low valuations. As I showed you at the beginning, it's underperformed for years, so we're looking extremely cheap. The question about, is it cheap, or is it a value trap where it's cheap because it's going to get worse, or is it cheap as a buying opportunity? And the election, the positive and negative case are almost two what I call bimodal outcomes. In that case, if you get a positive one, it'll massively release. You see the result every time you get even a little bit of good news from a poll, how the rand suddenly strengthens, and our South Africa Inc. shares push up. So there is a lot of pent-up energy there, which could see a massive run in South African equities, and especially those ones that are strengthening the rand, and that'll be relatively negative for the rand hedge ones, because they won't do as well. On the other hand, if we end up with a bear case, which is an EMF MK coalition, I mean, that comes straight with, as you can tell, appropriation without compensation, pretty much all of the negative results that we've been worried about for a while. That'll create a massive weakening of the rand, pretty much, close to a huge negative for the banks and South Africa, the South African retailers, things like that. That'll look really bad. Likewise, you'll probably see a benefit in the rand hedge shares. So right now, it's one of those ones where the outcomes could be very different based on an external event. And if you're looking at your portfolio, if you've got one that you think is more likely than another one, you could invest that way. We pretty much, I would imagine, going to have to be hedging out for both events. So we'd have to look at that as those possibilities, because right now it's a bit hard to say. I mean, I've read so many analysis, and you can read, depending on who you read it, you get their point of view. One of those outcomes is almost considered definite from, depending on who you're reading. So at this point, it's really hard to say, but I'd say it's most likely is we're probably going to carry on with things as they are, going slowly nowhere. But there is a very good possibility on either one of those extreme outcomes, which could dramatically change our lives in one direction, and the markets in one direction, and those are totally opposite directions. So there's no easy way to bet that, other than trying to stay in the middle so you don't get taken out by either outcome.
Thanks, Carl. A lot up in the air. So Geoff, perhaps over to you. The performances of this funds have been pretty strong, and you can see that with the second quartile performance everywhere. Do you believe the restructuring's been a contributor towards the outperformance? Firstly, and then second of all, how have we structured the portfolios in the run up to what may or may not happen within the elections?
I'll answer the second question first. I think there is a lot of risk in structuring a portfolio on a binary outcome. Like, in other words, for us to forecast the election results and the impact on the rand, as Carl said, there's three scenarios. It's the go nowhere slowly model, there's the bull model, and the bear model. And I think it's quite dangerous to try and forecast that and build that into the portfolio, because you could be wrong. And so I'm going to, at the risk of sounding like an economist, which I'm not, by the way, I think that you need to just rather take a considered approach. So we've been, as you know, in the portfolios up weighting offshore. We'll continue to do that. In fact, probably up to the elections, we will accelerate some of the offshore allocations just to take account of the current rand strength. But I wouldn't like to build the portfolio for one specific outcome. So the truth is, you want, in this type of environment, the point of least regret. You are going to regret one way or other. If there's a positive outcome, you're going to regret having too much offshore. Negative outcome, too much local. Go nowhere approach, probably that might be the least regret. So therefore, you want to just make sure that you've got a decent, in terms of your strategic asset allocation, a decent amount offshore and onshore. Yeah, I mean, maybe that might also answer your first question, in terms of the potential continued outperformance of the portfolios. I think that barring that offshore allocation, I think that they continue to look. I think they continue to be well structured. There's nothing leaping off the page at the moment that says we should be concerned either about a specific manager or about our current investment strategy that we've allocated.
Yeah. Thanks, Geoff. And then, Cam, if I can hand this one to you, the question is, what exposure did the Cinnabar funds have to the taxi notes, and what is the expected outcome for investors?
So we had two fund managers that we invested into that had allocations to it. One of them had an 8% allocation, another one had a 2% allocation. So individually, those are quite high and speaks kind of to what the multi-manager philosophy that we employ is if you had invested directly into one of these fund managers, you would have lost up to 4-5% at least so far, could potentially stretch on to about 8 or 9%. But because of how our portfolios are structured and because we blend these managers together, our portfolios have only immediately dropped 0.34%. There is potential for it to drop another 1.6%, depending on just on how they whether they can get those assets back. But it's generally quite a long, drawn-out process. But so the assets have been side-pocketed at the moment, so put into a reserve fund. So it won't impact any new investors that come into our funds, but it will just have had a initial knock-on performance initially. So overall, very small impact. And yeah, so we're happy with diversifying and keeping our income managers quite spread.
Okay. Thanks. I know we're over time, so I'm expecting people to start dropping off. I'm going to see if we can wrap up with the next. There's still lots of questions outstanding, but I'm going to select a couple. The one is from Brian, and Brian asks for a better understanding on the allocation, the asset allocation of the global fund between worldwide versus US equities, and I think it's probably worthwhile going into a little explanation as to the revenue generation for the underlying equities as well. I think it would be fairly interesting. So Cam, if you've got those two slides to hand, it'd probably be interesting to bring up. All right. So at the moment, this is the asset allocation to within the Cinnabar global balanced fund to equities. And as you can see, this is just the equity portion, not the defensive portion of the portfolio. But the equity portion is fairly heavily leading towards the US stock market and to US companies. This isn't the full picture though, because the full picture would look at where that revenue is actually generated from. So if you invest into Google, for instance, or Alphabet, just because it's a US-based investment doesn't mean that you're fully exposed just to the US, because Alphabet generates revenue from every single one of us, but also from the rest of the world. So in terms of revenue exposure within the portfolio, we've taken a look at this for the equity portion, and the exposure to revenue is 47% of the portfolio is exposed towards revenue generated from the US specifically, which is in line with the ACWI. ACWI stands for the All Country World Index, so it's very much in line with that. It's not out of line. So we're fairly comfortable with that at the moment. I'm going to choose one more question, and Carl, it's directed towards you, and then we'll wrap up. So from Joshua, I'm under the impression that South Africa is one of the largest uranium resources in the world. How are we positioned, and how could SA benefit from this based on our positioning?
Well, actually, there isn't any pure play uranium mines, or there aren't pure play uranium mines you can invest in South Africa. Actually, Namibia has one of the biggest uranium sets of mines in the world. The biggest resources are actually in Australia. Kazakhstan has about 70% of the world's productions in Kazakhstan and Canada. Australia's got one of the biggest resources, but they don't allow uranium mining in Australia, so you don't really get uranium mines there. But it looks like that might soon be changed. Actually, there's a law there. There's a lot of talk about that. But actually, Namibia has, I think, one of the biggest uranium mines in the world. I can't remember the exact size of it now, but that sits in Namibia. So they've got some big ones there. And we do get some uranium from some of our offtake mines here. So there is some byproducts, but not specifically South African. And of course, where they are listed, they're all listed in Canada anyway, or Canada or the UK or Australia, even if they are uranium mines. So that's pretty much where if you want to get uranium exposure, you have to go buy in those markets.
Thanks very much, Carl. All right. With that said, I'd like us to wrap up. I'd like to thank everyone so much for joining us for this quarterly. We hope it's been interesting and useful. Added a few nuggets to your life that you can use in your everyday life. I'd like to remind you of the ecosystem that we have put together, which is where we are helping advisors double their profitability. We're giving cutting-edge technology, providing a book risk analyzer to make sure every single client's looked at each month, and then assisting with implementation and succession. So looking forward to seeing each of you in 3 months' time and reporting back to you on what will hopefully be another good quarter after a peaceful election. Have a great rest of your day and make the rest of the week powerful. Bye, everyone.
Bye-bye.